Students, now let's have a look at another chapter. Chapter name is called Distributions to the Shareholders. What is the distribution to shareholders? The concept and types of dividend. Dividend refers to the portions of net income paid out to the shareholders. It is paid in cash or stock for making investment and bearing risks. Dividend payout ratios. What is dividend payout ratios? The dividend payout ratio is the percentage of currency paid out in the form of cash dividend is known as the dividend payout ratio. And retention ratio. Retention ratio is the percentage of earning retained in the firms is called retention ratio. Dividend policy. Dividend policy is concerned with determining the proportions of firms earning into dividend and retained earning in the firms. Now, let's have a look some basic concepts. It is the most popular form of dividend, a firm which has enough cash and doesn't have expansions program in near future prefers cash dividends. So this is the definitions of cash dividends. And this one is stock dividend. Definition is, it is also called bonus share. A firm that doesn't have enough cash and weak liquidity positions prefers the stock dividend. The factors affecting dividend policy. There are several factors. They are legal requirement, the net profit rule, insolvency rule, firms liquidity positions, third, repayment need, fourth, restriction imposed by shareholders and preferred shareholders. Investment opportunities. This is also affect dividend policy. Stability of earning, desire for control, access to capital market, stakeholders, individual tax situations. The dividend payment procedure. Dividend payment procedure. There is 4 stages in a dividend payment procedure. The first one is dividend declaration date. What is declaration date? The date on which directors meet and announce dividend payment date is declaration date. Date of record. What is date of record? If board of directors meet on the July 10th and declares a 10% dividend to shareholders of record on September 15, this September 15 is the date of the record. What is ex-dividend date? The date when the right to the dividend leaves the stock for new owner is called ex-dividend date. And final, it is known as payment date. What is payment date? At the time of the dividend announcement, the board of directors specify the date on which the payment of dividends is actually made, and it is called payment date. What is dividend policy and practice? Stability in dividends. What is stability dividends? The common shareholders generally prefers a stable dividend policy on their investment. So what is stable dividend per share? Or constant dollar per share dividend is paid. For example, company may decide $2 or $3 per share dividend. So in this case, earning may fluctuate from year to year, but dividend per share is constant. I will make one diagram here. 1 2 3 4 5 year, 1 2 3 4 5. Y-axis is EPS and DPS in dollar. So the dividend would be constantly increasing year by year, but the earning might be a variable in the year. So this is known as let's have a look at another type, which is known as constant payout ratio. It is the ratio of dividend per share to the earning per share. So it is actually earning per share. So it is dividend per share and earning per share. It is known as payout ratio. EPS earning increases, the DPS also increases. When EPS decreases, the DPS also decreases. So that means the DPS will follow the earning per shares or EPS path. For example, here again 1 2 3 4 1 2 3 4 5, this is year, this is DPS and EPS, this one is the EPS. So this is EPS. The DPS will exactly follow the same pattern. Thirdly, there is one policy which is known as residual payout policy. What is residual payout policy? Firms pay dividend to shareholder only investment need at desired debt equity ratio. Amount of dividend is NI is equal to net income equity finance required by new projects. Residual payment policy. Spice Co Limited has a target capital structures which consist of 70% debt and 30% equity. The company anticipates that its capital budget for the upcoming year will be 3 million. The company reports net income of 2 millions and it follows the residual payment policy. What is the dividend payout ratio? So here we are given here debt financing is equal to 70%, equity financing is equal to 30%, investment is $30 million and net income is 20 million. So that means dividend can be found as net income minus position of equity financing. Net income we know that 20 million and positions of equity financing we will be calculating as 30% of 3 million. So we get here 110. Then now we can calculate dividend payout ratio. Is amount of dividend divided by net income. Amount of dividend is obviously we calculated here is this one and net income is Then we get here 0.55, which is 55%. Let's have a look some important points and topics. The very first one is stock dividend. What is stock dividend? Stock dividends simply refers to the dividend paid to the existing shareholders in the form of additional share of common stock. Unlike cash dividend, it doesn't result into cash outflows. The purpose of stock dividend is to conserve cash in the firm so that it can be used in new projects. It simply involves the bookkeeping transactions of transfer from retained earning to capital stock account. The stock dividend doesn't affect the equity positions of shareholder. Rather, it represents a recapitalization of company which takes place in the form of transfer of certain amount from the firm's retained earning to the stock account. Another, let's have a look at the stock split. What is stock split? It is similar to the stock dividends in economic sense. When company announces stock splits, it results in the increase of number of share outstanding with a proportionate decrease in par value and market price of the stock. Therefore, firms with high market price split their stocks in order to bring market price within a reasonable limits. Lastly, the main purpose of stock splits is to enhance marketability of shares, bringing it within optimal price range. Here is the reverse stock splits. When a company's shareholder falls, share price falls drastically, company may want to reduce the number of share outstanding. Number of share is reduced by reverse stock. So, the reduction in number of share outstanding increases both par and market price of the share. It increases both earning per share and dividend per share as well. Finally, stock repurchase. What is stock repurchase? It is buying its own share by the company from the market. Repurchase program reduces the number of share outstanding and it is also known as treasury stock. Stock repurchase can substitute the cash dividend as a way to distribute funds to stockholders. So, it can increase the shareholders' value by increasing earning per share and market price of share.